This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
In a week dominated by some absolutely amazing returns from some tech stocks, this week I'll look at two non-tech names who also have been keeping pace, as well as a stage set for the big Fed meeting this coming week. Welcome to the Wise Investor Show podcast. I'm Chase Henderstein, and this past week has been largely dominated by the corporate headlines, notably the results from a few tech leaders in the market. And maybe I'll touch on that later on. But first, I want to give a quick look at the broader picture, as depending on when you're actually listening to this recording, we're really just a few days away from the September Federal Open Markets Committee meeting and what's expected to be the first rate cut since last year, and some potential for a cut maybe greater than 25 basis points, and maybe the first of even 2 to 3 cuts still in this calendar year. The first bit of economic news that really got attention this week was this latest revision to the U.S. jobs report for the 12-month period, which ended this past March. This is why quantitative investors, people who are running large models, don't input data that can later be revised, because it's really not too useful if you're putting in a piece of data and then have to extract it and replace it with something vastly different later on when you've already traded off it. But you can look at it to at least get the kind of directional flow of things. However, in this revised report, it was concluded that the U.S. added 911,000 fewer jobs over the trailing 12 months, cutting that original projection in half. And according to the Wall Street Journal, that was the largest revision on record over the last 25 years. Not only is this subject to more revision, but also employment data has always been. Go back to the most rudimentary academic environment. Employment data is considered a lagging, not a leading indicator. But it is important we do pay attention to it because we're keeping the Fed and the Fed's rate decisions in mind. And this trend to a weaker employment landscape and a weakening economy, ostensibly, do support the case for cuts for the rest of this year. Goldman Sachs, in their report responding to the August unemployment data, said that while they are, quote, penciling in an upward revision to the August payroll estimate next month, as seen in 12 of the past 15 September reports, end quote, they say that these figures are going to remain under their estimates of 80,000 new jobs a month, or basically what's required to keep unemployment rate steady. You got to keep adding at least 80,000 jobs a month, which will keep a flat change in the unemployment rate. However, Goldman remain optimistic as they go on to say, barring any real collapse in employment, they expect the economy to accelerate through the end of this year as the drag from tariffs abates. And I'm not sure why they expect that pressure to ease so soon, but I guess maybe to normalize the pressure from tariffs. They just said that they expect the drag from tariffs to abate, but also that overall fiscal policy should be more supportive, which is obviously what we're looking at for next week. And also financial conditions remain looser amidst this monetary easing. They say that the recent employment data, quote, sealed the case for a 25 basis cut at this month's Fed meeting, end quote. And they project 2 more cuts, a total of 3 cuts this year. And right now, the bond market is pricing in over a 90% chance of a rate cut next week and 2 cuts total for the remainder of this year. So while I surely can't say for sure, I wouldn't expect too much of a party from a 25 basis point cut next week, but rather maybe an outlier risk to the markets. If the Fed really chooses to shockingly do nothing, that would probably be pretty big surprise when a cut is, in all respects, already priced in. And then maybe some upside if they did actually go 50 basis points, or potentially the market actually would get upset by that. David Rubenstein said that on CNBC this week, that the market would take a 50 basis point cut as a sign of the Fed sensing a real problem and sell off into that. And, we've seen that in previous markets in history where they've cut by 50 or more points or did a intermeeting cut. And the market doesn't really rejoice because of the lower rates. They get scared. I'm not sure if that's the stage now, but he said that 50 basis points would be a bit too much right now. But the real odds are now that they basically cut 25 basis points, but the market could respond pretty positively that day. And I keep saying could. Market could do whatever it wants. But one other scenario that I think is realistic is that the market rallies after that cut during the press conference if Jerome Powell starts to reiterate the themes that the market really responded positively to when he spoke just a few weeks ago at Jackson Hole. The other evidence influencing the policy is the most recent inflation data, which was released Wednesday and Thursday this week. Wednesday was the August producer price information, which came in actually below the FactSet consensus estimates with a year-over-year core reading of a 2.8% inflation rate. And then on Thursday, the consumer price information was released, which came in basically right on the estimate with a run rate of 3.1% inflation for the consumer in the year-over-year number. Per a report from the folks over at Strategis in reaction to this data, they said, quote, "We are not too worried about runaway inflation here. The U.S. bond market also does not appear troubled. The 10-year Treasury yield is 4.03% this morning," end quote. And, you might remember from earlier this year, I certainly mentioned it on the show, there was this kind of theme or narrative that the stock market's gains or the stock market's progress seems to stall out or would stall out as that 10-year yield ticked above 4.5%. And we're very well below that benchmark right now. And this would indicate that while inflation is still running above those Fed's stated goals, yet they are still likely to cut. Strategis went on to say that the initial unemployment claims report this week, which rose sharply to 260,000 new unemployment claims, is more worrisome than the CPI numbers, but that while it's not their baseline in their thesis, they say that this has the, quote, stagflationary undertones. Now, remember, while a cut does move the needle if they cut interest rates, it moves the direction towards supportive employment and away from battling inflation. But if it is indeed a cut of 25 basis points, they would still be above their stated and understood neutral rate, or what most people expect a neutral rate to be. So they would still be in hawkish territory with a greater emphasis on inflation fighting. But at that Jackson Hole speech, an element that didn't get the greatest focus was Powell saying that the neutral rate itself may be higher today than it is in previous cycles. So the one real wild card may be if the Fed board, as a consensus, believes that the neutral rate itself is higher, that we're actually closer to accommodation than previously understood. That would argue that we're closer to a balance between inflation and unemployment, and therefore less of an argument for more interest rate cuts. But still, the groupthink and certainly the pressure now does still point to at least that cut next week, which is absolutely what the market's banking on. At the time of this recording, we got the S&P 500 making all-time highs, as well as the Dow Jones Industrial Average, which had seen some more volatility itself and more downside recently because it doesn't have as much support from the kind of red-hot tech names. But as of Thursday, this rally in the markets was more broad-based, and the Dow and the equal-weighted S&P, they're both up about 8% for the year, while the S&P 500 and the NASDAQ are up 12 and 13% respectively. The real macro and monetary policy payoff is going to be delivered in the next week. So for now, I'm going to slip into a quick break here. But when I return, instead of this, I'll focus on some updates for a couple of individual stocks. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. So the big news is really next week, right? So let's spend the time we have left today. Instead, we'll look at the fundamentals of a couple of individual stocks here. These are companies that I like. I do own them both for myself, and we own them for our clients in our managed accounts. So while I'll try to be judicious and blend in some contrarian views or some downside risks where I can, keep in mind that my point of view is definitely jaded to the upside. I own them because I think that the stocks will do well. So I have that personal attachment and conflict there. But that being said, I'm not just telling you that I like them and why, but also sharing with you some of the more up-to-date analysis I have available from third-party resources. And while the tech names in the market have really done some remarkable things this year, in fact, I hear we're now calling it the Mag 8, or someone suggested the Elite 8, instead of saying the Mag 7 names. While those stocks dominate the headlines with these outstanding returns, I want to look elsewhere. With a bank first, at least it's a credit card company that kind of looks like a bank, in the name of Capital One, symbol COF. In May, Capital One completed their merger with Discover. That made them one of the biggest credit card companies in the country. It's actually, I think, now the biggest issuer of credit cards in the country. And it also, most importantly, maybe gives them this kind of complete end-to-end network that they own on their own, connecting them directly with the merchants and their cardholders, allowing for a more inclusive, greater capture of kind of all the fees involved in this kind of consumer lending. And for what it's worth, the stock, as I record today, it's trading up about 13% since that date when the merger was consummated, versus a gain of about 10% for the S&P over the same time frame. Again, surely there's some AI stocks there that have absolutely blown out of the water, but they've been doing well. Since the start of the year, and the merger wasn't done yet there, but we'll look at the beginning of the year because the merger wasn't assured. They could have had maybe not achieved final regulatory approval at that point. But according to the fact set, the consensus estimate for Capital One's earnings for next year, for 2027 and 2028, since the start of this year, they've gone from 1866, 20.4, and 1874, respectively, per share, now to 1995, 2503, and 2673 earnings per share over these next 3 years, each of these next 3 years. And, there's a good deal of variance in those numbers, but the bottom line I guess I'm trying to make is basically due to this merger, they're looking at an increase in average estimates of over 20% higher earnings over each of the coming years. Or what Goldman Sachs recently published regarding them as they added Capital One to their so-called conviction list, they think that the merger added about 30% earnings accretion for the year 2027. They point out that this is leaving them as the largest credit card issuer in the U.S., and it gives Capital One a path to completely abandon or move away from Visa and MasterCard entirely as they run all their customers, their consumers, all those charges directly through their own network. And historically, Capital One was considered overall a bank for the less wealthy consumers, lower credit quality, and they offered credit to riskier borrowers, as did the Discover card. They also had a similar profile. But today, Capital One is a far more ubiquitous name. And JP Morgan, in their analysis, points out that the company's Tier 1 capital ratio, or the amount of extra capital they keep to offset potential risk in their portfolio, is well above its historic average. And JP Morgan calls them now a leading depository franchise. To mix in at least a possible downside to the stock, JP Morgan points out, though, that any consumer cyclical downturn would obviously impair their earnings. But they also go on to say that they, quote, believe a modest cyclical downturn would rationalize pockets of consumer credit, driving future opportunities for growth, end quote. And they also added that Capital One's core competency is managing credit risk, and that their risk-based pricing model has always outperformed their consumer credit peers throughout all different types of environments. Back at Goldman, they have a $276 price target on the shares. That would be 25% higher than it trades today, which they come to based upon a 13 times earnings multiple based upon their estimates for next year. They do offer that risks to the shares are, again, weakening consumer credit and loan growth. You know, they're not really going out on a limb there. This isn't a stock that is going to outperform if you do indeed come across a softening economy. But it is one that screens as relatively inexpensive today. And while it's been doing well on a share basis, if we did see an environment like that, Goldman says, well, that would be time to maybe add to them for longer term appreciation if any weakness does indeed develop. Another one for today, also not cut from the cloth of AI and technology, is the kind of the development as a company as AbbVie kind of presents itself today. Another personal holding of mine and one in our portfolio, so same caveats. But having followed it for so many years, it's really kind of something to sit back and consider how it's evolved over all these years. It was originally spun out from as a piece of Abbott Labs. They took their biotech and what was drugs that were under development time, spun them off as this other company, and AbbVie made a big name for itself as the purveyor of Humira. Really at its peak, one of the most commercially successful drugs of all time, as it's used to treat a whole host of autoimmune diseases. And for years and years, it churned out cash flow and growing dividends. But the story in the stock for them for a long time there, I guess recently people have now, for reasons I'll get into in a moment, have moved away from it. But for many years, the drag on the stock was basically a one-trick pony, and they had this patent cliff as the patent on Humira would expire in the coming future. Well, through kind of fits and spurts over the years, they did indeed develop some of their own other drugs, and they leveraged their cash flow to purchase other companies' drugs that were under development, and sometimes with and without success. They had some stumbles along the way where you spend $1 billion on a drug that turned out to be a loser, and that was $1 billion lit on fire, but others did hit it big. Meanwhile, the biggest names on the shelf for them also came from close to home, because their biggest winners today also are from their immunology division, that same division that developed Humira, the drugs Rinvoq and Skyrizi, which if hopefully you don't need them, but nonetheless you probably see their commercials all the time. Each one today earned more this year than Humira has for many years for this company. Another big move that had kind of a weird timing for the company was they made a major purchase of a company that was basically focused on cosmetic pharmaceuticals, specifically the maker of Botox and other cosmetic applications. And they closed on that deal just really kind of shortly before the COVID pandemic outbreak. And at the time, that seemed to be really unfortunate timing, because just as we were all kind of hunkering down for a year or so, not going to the office and such, but it wasn't too long into that pandemic that folks decided that it was really that much more important to them, or some folks did, that they look a certain way because they're sitting there on Zoom video meetings all the time. So if you look back, the sales of cosmetics and these cosmetic therapeutics started to do quite well. Anyway, regardless of that origin story, the uses now for Botox and these other cosmetic therapies are selling twice as much today as they did before the outbreak in 2020. And they represent about 9% of the total sales of the company. For some perspective there, Humira itself, that wonder drug, is now about 7% of total sales. The bottom line is, although the stock's up quite a bit this year and has been making new highs, with the evolution of their drug portfolio to these diversified revenue sources, it's still trading at about a 20% discount to the high end of its valuation range over the last 10 years. But it did get a pretty good pop this past week because they also got a settlement over some litigation, and they got into a settlement that was reached protecting their patent on Rinvoq, now out into 2037. From a month ago, when AbbVie released their quarterly results, JP Morgan raised their forward estimates for the company and said that it was Skyrizi driving the forward beats. But most importantly, overall, JP Morgan at that time didn't see any further loss of exclusivity for this company now that the Rinvoq patent is somewhat resolved. They don't think that any of their current drugs that are meaningful or under any type of patent threat until at least the mid-2030s. They, JP Morgan, forecast top-line growth compounding at 7% per year, and that AbbVie's earnings growth is going to compound at 10% per year out through 2030. They also point out some real risks for the stock. More competition or economic headwinds could certainly impair that aesthetics business. That's what I keep referring to as the cosmetics business, as well as any unexpected changes to the U.S. healthcare system would certainly affect any of these medical therapeutics. Meanwhile, while you might be aware of some of those challenges in the news, their models already factor in some of the price competition in the models that's expected based on the current expectations based upon government-required price competition. So it's just if things got worse for them, they would maybe see some further price deterioration. All right, that's all I got for you this week. I'm Chase Hinderstein, and I do appreciate you taking the time to listen in to the Wise Investor Show.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.